podcast discusses exchange-traded options issued by the Options Clearing Corporation. Options involve risk and are not suitable for all investors. Individuals should not enter into options transactions until they've read and understood the risk disclosure document, Characteristics and Risks of Standardized Options, available by calling 1-888-OPTIONS or by visiting www.optionseducation.org. None of the information in this presentation should be construed as a recommendation to buy or sell a security or to provide investment advice.
My name is Joe Harwood, and I'm the manager of the Investor Services Call Center at the Options Clearing Corporation. I've been in the options industry for 25 years as a trainer, educator, and in the past, options trader. Some of you may have talked to me personally when calling the 1-888-OPTIONS help desk line. I'd like to welcome you to the next of the series of podcasts designed to help investors like you understand the benefits and risks of trading options. Today, we'll be talking about the very basics of the options product. We'll cover some of the concepts, terminology, and some of the mechanics of options. You will end this podcast understanding a little bit more about how options are used in the markets. Please note, options involve risk and they are not suitable for everyone. And prior to buying or selling options, you should receive a copy of Characteristics and Risks of Standardized Options. You can obtain the document by going to the Literature and Brochures section under the Trading Tools tab of the optionseducation.org website. Or you can call us at 1-888-OPTIONS. For purposes of all the computations discussed in this podcast, commission fees, margin interest, and taxes are not included in any examples. These costs will obviously impact the outcome of any stock or option transaction. Any strategies discussed, including examples of price data, are for educational purposes only and are not to be construed as an endorsement, recommendation, or solicitation to buy or sell securities. Great. Now that we've had an introduction, let's get started. Thanks for listening to the Equity Options Podcast produced by the Options Industry Council. Our goal today is simple: to introduce you to the world of equity options. Previously, we talked about options being a particular kind of security called a derivative, or an investment product whose own value is derived from the value of something else. In the case of equity options, their value is derived from the value of an underlying stock. We also pointed out that just like shares of stock, equity options are listed and traded on exchanges that are subject to certain regulations with U.S. Securities and Exchange Commission, or the SEC. Please refer to sec.gov for some information in this matter. Today we'll start to focus on what equity options are and how they work. A good way to begin is by pointing out important differences between options and stock. Although they are both classified as securities, what you are actually buying in either case is quite different. Let's take a look. When you buy stock, you become a part owner of the company issuing those shares. In other words, you have an equity interest in that company, and this comes with certain privileges. First, if the company chooses to distribute excess cash to its shareholders in the form of dividends, you're entitled to receive those payments. Cash dividends you might receive in effect increase the return on your stock investment over and above any change in the value of those shares. Secondly, you can vote for or against certain management decisions that might be put to shareholders for approval from time to time. An equity option, on the other hand, is really a contract. Even though this contract's value is derived from the value of its underlying stock, buying an equity option does not give you direct ownership of that stock. Instead, one equity option contract gives you the right to buy or obligation to sell 100 underlying shares at a specified price on or before a given date in the future. You have no obligation whatsoever, only a right to buy or sell the stock if you choose to do so. As the buyer of an option contract, you are in control of this decision. To take a closer look at some of the features and characteristics of equity options, let's compare an option contract to another type of contract you're all familiar with, an insurance policy you take out on your car. Since you understand how an insurance policy works, making this comparison should help you understand some of the similar characteristics of an option contract we're going to cover. Okay, so you've purchased an equity option contract. How do you put the right you've bought into action? Or, in other words, how do you actually buy or sell 100 shares of stock if and when you make this decision? You exercise this right by giving your brokerage firm instructions to exercise your option contract. Again, whether you exercise the option or not is totally up to you. Now, think about a car insurance policy you might buy. In effect, you've really bought the right to be paid for repairs if the car is damaged. If you were to have an accident, you can exercise this right by filing a claim with your insurance company. Now, let's consider profiting from your option purchase. To realize a profit, do you eventually need to exercise the contract and buy or sell 100 shares of stock? No, not at all. Like virtually anything else you might buy as an investment, if you can sell it for more than you paid for it, then you'll see a profit. If you sell your investment for less than you paid for it, then you'll realize a financial loss. These simplified common sense rules can apply to option purchases. As we've already discussed, options derive their own value from the value of their underlying stocks. And since stocks commonly fluctuate in value, so can the options based on those stocks. So if you sell your option contract in the marketplace for more than you bought it for, then you'll see a profit as long as the commissions you pay your brokerage firm for both the option purchase and sale transaction are covered. If you sell your option for less than its initial cost, then of course you'll see a loss. An important point to understand about all this is that once you do sell your option, you're out of the marketplace. You no longer have the right to buy or sell underlying shares that buying the option initially gave you. There's another important difference between buying stock and buying options. When you buy shares of stock in a company, you own them until you sell them, and the timing of this is your decision. There is no lifetime for the shares unless the company goes out of business, merges with another company, or perhaps gets taken over. An equity option contract, on the other hand, is quite different. It has a specific lifetime. In other words, like many other types of contracts, it will eventually expire. Simply put, it has an expiration date. Remember our original definition of an option contract? Buying one gives you the right to buy or sell 100 underlying shares at a specified price on or before a given date in the future. This given date is the contract's expiration date. After this point, if you haven't sold the option or exercised it, it will expire with no value. The right you have to buy or sell 100 shares also expires. Before expiration, however, you can sell or exercise your option at any time. Compare this feature of an equity option contract to the car insurance policy we referred to. The insurance policy will also expire on a given date, and after this time, you're no longer insured. You must buy a policy to renew your coverage. Do all options have the same lifetimes? No. The lifetime of any option you buy is up to you because in the marketplace at any given time, you'll find a wide availability of contracts based on the same underlying stock with a range of lifetimes or expiration dates. You will generally find shorter-term contracts that expire in the next 2 calendar months, along with other contracts that expire up to 9 months in the future. In some cases, you might find longer-term options that expire up to 3 years after you buy them. Should you consider shorter-term options or longer-term options? This will be your choice. There are advantages and disadvantages of one versus the other, which you'll understand as you learn more about options. Now you understand that buying an equity option contract gives you the right to buy or to sell 100 shares of the underlying at a specific price, and that you can exercise this right at any time before the option expires. So what do we call that specific price? It's one of the terms of the option contract and is formally referred to as the option's exercise price, but also commonly referred to as the option's strike price. Don't let these two terms confuse you. They mean the same thing. If your option gives you the right to buy 100 underlying shares, then you will pay the exercise price per share when you exercise the option. On the other hand, if your option gives you the right to sell 100 underlying shares, you'll receive the exercise price per share when you exercise that contract. An important point to understand here is that the exercise or strike price is one of the terms of an option contract. It is fixed in that the strike price remains the same, no matter what the price of the underlying shares is when and if you exercise the contract. Do all equity options have the same exercise price? No. Just like expiration dates, you'll find an availability of contracts based on the same underlying stock with a wide range of exercise prices. When you're buying an option, can choosing one exercise price versus another affect your profit potential? Yes, it can, which you'll understand as you continue your options education. Let's review again our very general definition of an option before we move forward. Remember that buying an equity option gives you the right either to buy or to sell 100 underlying shares at the exercise or strike price per share if you exercise the contract at any time before it expires. What we haven't discussed is that there are two distinct types of options, calls and puts. One gives the option buyer the right to buy underlying shares. The other gives the option buyer the right to sell the underlying shares. Let's consider call options first. An equity call option gives its buyer the right, but not the obligation, to buy 100 underlying shares at the strike price per share if the contract is exercised before it expires. If the player began hitting one home run after another and he became an all-star at midseason, increasing numbers of fans would want to buy the ball. The value of that baseball would increase along with the player's success and fame. If, on the other hand, the player's batting average plummeted and he was dropped from the team, the value of the autographed baseball would drop as well. If there were no fans to buy the ball, it would probably be worth less than it initially cost, or possibly nothing at all. Now let's put together a call option on this ball. Say you're interested in buying in early May, not long after it was autographed, because you think this player has talent and his batting average is going to improve tremendously. At this point, you have more confidence in this player's potential than other fans and want to buy the signed baseball to add it to your collection. The fan who owns the ball is willing to sell it to you for $100. You don't currently have the cash to pay that much, so you buy a call option on the ball that will expire in July on the day the all-star teams are announced. Here are the terms of your call option contract. You've bought the right to buy one autographed baseball for $100, your exercise price, at any time before the all-star players are named. To purchase the ball, you just notify its owner of your intention to exercise your call contract, and he hands over the ball and you pay him the $100. To purchase the ball, you merely notify its owner of your intention to exercise your call contract. He hands over the ball and you pay him the exercise price of $100. The ball is then yours. In the options world, that ball could have been 100 shares of stock. Remember that a call option gives its buyer the right to buy 100 shares. Now let's consider the other type of option contract, a put option. An equity put option gives its buyer the right, but not the obligation, to sell 100 shares at the strike price per share if the contract is exercised. Let's go back to our baseball analogy. Say you bought this ball after it was signed in hopes of it increasing in value along with the rookie player's continued success on the field. However, you begin to grow nervous about the player's performance